We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Wadsworth and Patrick Karim from NorthstarBadCharts.com. Kevin, how are you today?
I'm great. Thanks, Tom. Thanks for having us back on the show.
Always great to have you both. Pat, how are you?
Not bad. Not bad.
So it seems like, you and I, I've interviewed both of you separately. I've interviewed both of you together. We've been talking about this breakout in metals for a long time, and it does seem like it's finally here. So maybe we can start by, thinking about what constitutes a breakout for the metals.
You want to go for that, Pat?
You want me to handle that? That's the toughest question. Where I don't know if I'll be able to do it.
or maybe what starts to really weigh the evidence side for a real breakout in the metals.
Yeah, I was kidding. I'll if I share my screen with a few interactive charts, I think we'll be able to give a lot of evidence for your viewers. So I'll just start with a fresh trading view, and I'll put the gold chart. So there's a few things you need to look at. Remove drawings, and I'll just put my hollow candles. So for people who aren't familiar with Japanese candle charts, essentially they are the body of a candle. The bottom of the rectangle is the start of the month or whatever that time frame is. This is a monthly chart. And then during the month, the price goes down and up. If the price goes below the start price, then you'll have a little wick at the bottom. And if the price closes the month but the intra-month the price went up, it'll leave a wick on top. And those wicks, we consider that noise from the smaller time frames. The line, the close, is probably what matters most. So right here for gold, this on the monthly chart, 1 touch, 2 touch, 3 touches. So a trend line, a valid trend line, morphs into existence on the 3rd touch. The more touches, the more powerful it is. You can see here the base back in the 2019 base had 1, 2, 3, 4, and a breakout. So if you ever see a base like that, guys, and a close above that's my 7-year moving average, it's like, I don't want to say bet the house, but it means it's a higher probability play that this huge base will create a very strong move upwards. So now we've had a consolidation, 1, 2, 3. And well, on the monthly chart, we had a confirmed breakout out of this descending trend line. That's not the final breakout. So that's just that slightly angled trend line break is there. Here, I just put a horizontal breakout line off the highs of the close of July 2020. Right here, see there's a wick. Everybody thought this was a breakout here in March of 2022, but you see how the sellers came in. It was just a wick. And last month, we weren't able to convincingly close above this level here, about 1977, 1980. But this month we are. So right now, if ever we close the month convincingly above this line, that is a monthly defined breakout on the gold chart. So that's just the first piece of evidence. Then I could zoom out easily to the quarterly chart. Here we have on the line chart, Kevin had identified a megaphone pattern. I'll just remove drawing. So megaphone pattern, essentially you have 2 bounces on the bottom, a lower low, creating volatility. And on the top, you have 2 highs, higher highs, and then you have a break. But we didn't have the break previous quarter. It was just on it, but this month it's continuing upwards. So if ever you Google bullish megaphone or megaphone continuation pattern, this is textbook. So if ever we close June 30th, is that the quarter? Q2, yeah, June 30th above here, that megaphone pattern enacts a measured move, which is probably, I think it's this, Kevin, right? It's the pole.
Around about $800. The flagpole is about $800 high. So that's just one technique for measuring where the target might be. There are several different techniques, and what it ends up giving you is a sort of a target area. There's no one technique that is going to give you a definite answer, but what you can start to do using techniques like this is to calculate a range of answers as to how high gold might go, and then it gives you that sort of target zone.
That's right. So
with
right
just
there,
an idea of what might come, right? Like it's not that you're setting a specific target of that's when I'm going to sell or basing any concrete decision on that.
No, it identifies where price is going to be naturally drawn towards if we get the confirmed breakout that Pat talked about, and you can see the megaphone pattern here. And if we get the confirmed breakout from that pattern, then that is the rough area where price is likely to be attracted towards. The supporting evidence has to be behind that, though, and supporting evidence will come from ratio charts like the gold to SPX ratio, for example. That kind of acts as you need a fuel for this move. You need a number of things from a technical perspective that are going to power this move, and the biggest thing that's going to power this move is a capital rotation. Where's the money coming from for gold to move up $800? Which market is it coming? Where's all this investment money coming from? Well, bullion banks buying gold, of course, and all that kind of stuff. But you can spot these trends, these cyclical trends on the gold to SPX ratio every single time, without exception. Every single time that gold has a substantial move, the gold to SPX ratio breaks out, because it doesn't take very much capital rotation from global stock markets. And you could also use gold to NASDAQ or gold to Dow. You could do the gold in your currency, like here in the UK, gold in British pounds versus the FTSE 100. It's the same thing. What you're doing is you're spotting the rotation of capital disproportionately away from the stock market and towards gold. So this ratio chart, when it goes down, it means that the SPX is outperforming gold. And when the ratio goes up, it means that gold is outperforming the SPX. So it's spotting the preferential capital flows between the two. It's ratio charts are always a two-horse race. They only tell you what those two horses are doing. Is it, if I had to hold one of the two, if I had to hold SPX or gold, which would I hold? That's the question that it's answering. It's not telling you if gold's going up. It's not telling you if the SPX is going up or down or sideways. It's telling you how they're performing relative to each other. So if you hold gold when it's going up, you're either going to be gaining more or losing less than if you hold the SPX.
Mm-hmm.
That's right.
Yeah, that was. Go ahead, Pat.
Just to say, that is true. But then what you have to do is, once you have a ratio chart of two major asset classes, then start thinking, where else did I see a pattern that looks like this chart? And then you'll start to understand it's like a Rosetta Stone. Look, ASA. ASA is the oldest precious metals gold fund. So it's gold and silver miners in there. There's a whole bunch of gold and silver miners, producers, explorers, a whole bunch of stuff in there. And look at that. By miracle, look, it tracks pretty much the metal gold and SPX gold divided by SPX. So there's no CEOs in gold. There's in here, there's a whole bunch of different companies, but for some miracle, whatever gold is able to strip out the capital flows, whatever its money supply coming in, everything, and gold's able to outperform SPX, whether, like Kevin said, whether the ratio is going up, but gold and SPX are both going down, but gold going down less fast, or whether the gold and SPX are going up, but gold's going up faster. The miners track that, guys. Look at that. Look at this beautiful. So this is why it's key that whatever happens here will drive your precious metals investment, your gold, silver, and all that. And I could even overlay the actual silver chart, because silver, people are saying, how come silver's not back at all-time highs? Well, guess what? Silver tracks, and I'll put it on log scale. Here's my silver chart, log scale. Look at silver. It tracks the gold to SPX chart. So that's what silver is waiting for. It's waiting for the capital flow. So as soon, and it's starting to look very bullish now for the SPX, gold to SPX. If gold to SPX is able to rocket up here, silver is going to probably break out of its. Here's my silver chart. Silver has a long term. It's probably going to break out. The miners are going to go bonkers. Everybody's going to go bonkers. Palisade's going to have over 100,000, 200,000 subscribers on YouTube. It's going to be crazy stuff, man, Tom, when this happens here. And that's just the prelude, because the real move occurs when gold is worth 2/3 of SPX. So the first level is gold worth half. And that's just this mini move here. Maybe we're going to peak when, Kevin? Early 2024, maybe we're going to peak. Then a higher low here. And once we break out here, this is the true reverse symmetry move. So in TA, I'll just remove strong moves down. Once you break out on the opposite side, you get a fast reverse symmetry move that often mimics the energy that went down. 76%, 76.
It's the analogy that people sometimes use about a beach ball being held underwater. These charts display characteristics that are sort of reflection of physics, really. Very often, if you're a physicist or a mathematician, you probably, I'm not going to go into great detail to explain it, but when you force something too far away from its natural position, then the reaction afterwards kind of mirrors the move in the opposite direction, and it's a question of stored energy. In this case, it's investment energy. You see it over and over. Here's reverse symmetry move. Here's another one. Here's gonna that. So this is the move. This is the move that makes us go bonkers. It's this. This is the pay dirt one. Mm-hmm. We're living right here. It's a wake up. So this line here, that was the bear market rally for gold versus SPX. But just this bear market rally, the lows of 2018 all the way to the peaks of 2020, gold went up $800 from $1250 to above. So imagine in a bear market rally for gold versus SPX, it was able to gain 800. Right now it's starting. This move right here, that's probably the one that's going to bring us to 26, 2800 or 3100. If we look at the first chart we did with the megaphone pattern, we're probably going to be close to 3100. And I'll show you maybe a technique to show you when you're stretched from the moving average, where you should take profits. And then after that, once we're able to consolidate and break out above, I don't know how low it's going to go, then this is the pay dirt move where everything goes really, really bonkers. And as Pat was saying there, it's important to know when you're getting stretched from the moving average, so that you can put the distance from moving average indicator on, and you can use historic precedent to give you a very good idea when you need to start getting a little bit twitchy and thinking about taking profits. There are some very clearly identifiable horizontal resistance levels that when you hit them, it's often good just to take profits, partial profits, or even step aside just whilst the market decides whether it's going to pull back significantly or whether we've got another imminent up leg developing rapidly. But those levels are important for resistance.
Yeah, here you see something that we kind of touched on before we hit record was just, technical analysis doesn't necessarily lay the perfect picture out, but you're adding to the weight of evidence of a couple different outcomes, right?
Well, so when you're forecasting the future, Tom, there are multitude of different possible pathways and possible outcomes. And technical analysis, what it does, it takes takes everybody's sort of fundamental thesis and narrative, and it visualizes. I think we're going to talk about the US dollar in a little while. And it helps you to visualize what you're thinking. It's a map, and starting from point A to get to point B on a map, there are multiple ways of getting there. And also, you might not end up at point B. You might end up at point C, D, or E. So you wouldn't set off on a hike without a map and compass. Not if you really want to be knowing where you're going and knowing if you're wandering off the path. And it's exactly the same with the price of gold or silver or a mining share or Bitcoin or anything else. You need a roadmap, because without a roadmap, you don't know if you're your assumptions are correct as you're traveling along. You've got no reference point. If you don't have a technical chart to refer to, you're kind of blind. You don't know what's coming next if you don't look at the technical chart.
Mm-hmm.
That's right.
Pat, can you give us a little bit of an explanation on the Ichimoku clouds? I know you and I have spoken about that before, but that's the green and red clouds above that chart there.
That's right. Just the Ichimoku cloud, we love it because it represents visually the trend and resistance and support that's being defined and projected in the future. So if it goes down really, really fast, it doesn't have much time to generate a lot of resistance. So here is the way when it moved down here created that resistance. It's thin. See, when it goes up here, it's thin, it's vulnerable. If ever the price starts really faltering, it has an escape route, not much support. But as price goes sideways for longer periods of time, then the cloud starts contracting and sometimes flipping from green to red. And that means the moving average is often close to it. And then you have a chance with the price action, if it's able to get it back above the red cloud, that resistance, then it has clearer skies, it has a higher chance. Look, this is a perfect example. I'll just zoom in what happened in 2018. The bear market rally for gold versus SPX. Even here, like we got super like, oh man, it's going to 3,000. But if we would have paid attention to the gold to SPX ratio and look at the monthly chart, look at the wick. By the end of the month, the price action got contained within the red Ichimoku cloud, the resistance. The next month, it gapped up, it closed within. And then after that, even here, it couldn't close out of the cloud, got dragged back in. And then after that, you were closing below the support line, and that move was done by then. And then we fell. But look, now over time, the cloud is thin and has an escape route to get out of there. So this is very constructive to spot basis.
Also, you can look at the breakout in 2004 there, Pat, or 2003 on the left-hand side of your chart, and you can see how price broke out. It actually progressed right the way through the thick part of the red Ichimoku cloud there, and it does do that sometimes. It's less common. Usually when price passes through the cloud, it targets a weak spot, but that's not always the case. But what you can see here is that it came back and it tested the Ichimoku cloud as it had turned green and started rising in 2005. So even though it managed to get through the cloud there, what it did, it came back and it back tested the top of the Ichimoku cloud. So the way to treat it is really as part of your weight of evidence. You need to look at moving averages. You need to look at your technical indicators. You need to look at horizontal and slanted support and resistance lines. But the Ichimoku cloud is part of that. And very often when you break out, one of the levels that you come back to test is support or resistance on the Ichimoku cloud. It's always worth as I said, a bit like having a map. It helps to orientate yourself. Mm-hmm. Once you're above the cloud, it's kind of like looking at your map and ticking something off. It's like, okay, well, we're on the right path now. This particular piece of evidence is telling us we're more likely to be in a bull market than a bear market because we're above the cloud. We're above the moving average. That's another tick in the box. We're on the right path. So right. It's about knowing when to enter and when to exit with trading and investing, of course. And having a technical analysis chart really does help to give you the scientific evidence that helps to confirm what you think you know. And that's crucially important because having a view or an opinion is fine, but you have to have some evidence, some solid hard evidence to back that up.
So when we think about and do all of this analysis, guys, is there a, let's say a time period that you guys feel that we could see gold be in a bear market or a bull market for?
Yes, there is. And many of the charts, I don't know how detailed you want to get to in the discussion, but many of the charts point to somewhere in the late 2020s as being a high point for gold, and really looking forward more than about half a dozen years starts to get somewhat murky. But you can use the cyclical behavior of gold, and you can use the cyclical behavior of the gold to SPX ratio, and you can also use the cyclical behavior of the SPX versus inflation ratio. So you can look at all of these charts, and what you end up doing is you start putting together a timeline and evidence that either supports what your sort of vague idea is, or it starts to give you reason to rethink and reconsider. And a little bit like it's just like forecasting the weather. Is it going to be 20 degrees tomorrow? Is it going to be 22 degrees or 21 degrees or 23 degrees? Well, you get a ballpark idea from using all the meteorological forecasting techniques, and broadly speaking, is tomorrow going to be a hot day, or is it going to be a cool day?
Mm-hmm.
And again, with precious metals, you can work out where the trends are most likely to lead us, and you can also work out the timeline that it's most likely to occur in. So what you end up developing is a map that gives you the most likely path, the most likely scenario. But you always have to bear in mind that there's a smaller probability that an alternative outcome will materialize. So as you travel along that route and along that path, you're always looking out for signs and indications that might be telling you that you need to reconsider your analysis. And if you're not constantly reconsidering the analysis, then you're not doing it correctly. Because en route from where we are now to where we're going, a lot of things are going to change. A lot of stuff is going to develop and happen that isn't evident at the moment. But yeah, I mean, the charts do suggest that gold has a cyclical pattern to it. It does suggest that perhaps 2024, later in the year, there's going to be a significant low point after whatever kind of a rally we're going to get in the interim. There's some question about whether late 2022, last year, the point where we dropped down to $1,600 or so, there's a debate as to whether that might qualify as the 7 to 8.5 year cycle low, because gold does put in a major low point every 7 to 8.5 years.
Mm-hmm.
It's sometimes referred to as the 8-year cycle. But really, that, to my mind, wasn't really due until later next year. So it's quite probable that we get a significant move over the next 12 to 18 months, let's say, into perhaps the middle part of next year. And then later, at some point next year, we get a significant pullback. That makes a lot of sense at the moment. A move to the high 2000s, perhaps approaching the 3000 level, somewhere at that kind of level would be looking seriously at the charts for reasons to exit, being stretched from the moving average and all that kind of thing, ahead of what might be a significant drawdown.
Yes.
Later next year. So that's the broad roadmap. But first of all, we've got to get this confirmed breakout, monthly confirmed breakout for gold, and the monthly confirmed breakout for gold versus SPX above 0.5. So we're right at the starting gates at the moment. The miners have barely even moved.
I was going to say too, it's useful to have those other charts, the cycles and the ratio, the other ratio charts, to determine maybe where that the gold chart is headed, because not necessarily being able to understand from the gold chart if we're already past the all-time high, the previous all-time high, being able to project out of that where we're possibly headed from just the gold chart alone probably isn't the best.
No, and I mean, we can look at previous bull markets as well to estimate the final destination for gold. Mm-hmm. We can work out what's reasonable from the bull market in the 1970s, the bull market between 2000 2011, and also the move that occurred, I think it was 2018, wasn't it, where we went up somewhere around $700 or $800. So we're analyzing all previous examples of how gold has behaved when certain things have happened. How did gold behave last time SPX broke down versus inflation? How did gold behave the last time the gold to SPX ratio broke out? What sort of ratios for gold, the gold to silver ratio, you can use that particular metric to calculate the possible final destinations for both the gold and silver values. And it's not at all unreasonable to expect numbers in excess of $8,000, shall we say, from a historic point of view, is perfectly reasonable. People seem to forget that gold moved from a couple $100 to a couple of $1,000 during the last precious metals sort of significant bull run in 2000 to 2011. So, and people also tend to forget just how many years you often have to wait for the stock markets to get back to their previous nominal highs as well. So, yeah, you do have, you have to look back over history. You have to look back 50 or 100 years to get all of this evidence. But if you don't do that, you're kind of blind to what's possible and also what's likely. You have to scientifically build up an evidence case for what is most likely under certain circumstances. And the technical analysis is what allows us to do that.
Mm-hmm. So, Kev, as you're talking about a breakout, let's say, you guys on your website have what you call a 4 or 5 star breakout. So what, let's say, boxes need to be checked to constitute a 4 or 5 star breakout?
Well, I'll talk this through, and Pat can show it on one of the charts. He could pull up the gold chart if he wanted to, and just do it on the gold chart because it's so clear on the gold breakout back in coming out of the last bear market. So the first thing we look for during a pull, so first thing is to establish when you've exited the market because the market has topped, and you do that by using stretched distances from moving averages and a breakdown below key support levels. And if Pat were to put the rate of change analysis on this chart as well, the 7-year rate of change, this is a bespoke technical indicator that works incredibly well for gold. So he's on the monthly chart there. So if he puts the 28 period rate of change with its 3-year moving average. So this is an example of how the weight of evidence is used, not just looking at one particular tool, but using multiple tools. So we have on the gold chart, Pat's already put on the sleep mode line. And when a stock or precious metals or whatever it is crosses down below a rising support line that's clearly identifiable, and in this case, it's also quite closely following the 12-month moving average, gives you added weight of evidence that when it breaks down below that line, you need to start getting somewhat cautious. And Pat's just highlighted where it breaks down there. More important is where you get the horizontal breakdown. There's a horizontal support line in there that you can put in that gives you a sort of almost like a final, okay, time to get out of Dodge sort of thing. Mm-hmm. So the price begins to decline, and we're out of the market because it's broken down below the sleep mode line, below the 12-month moving average, and below the horizontal support line. So we're out at this point. So Pat can let the chart play, and we'll explain the 5-star breakout. So we're in a bear market. We're below the Ichimoku cloud. We're below the key moving averages, and price is developing as time goes by. We're looking to the point where we might begin to start turning bullish and wanting to re-enter the market. We're testing the Ichimoku cloud there. We're above the wake-up line. So once we get above the wake-up line, that's your first star, by the way. So you get a star for breaking out above the wake-up line. That's a point of interest. It's a point where a lot of people start to turn very bullish, and they draw their line saying, right, we're going to new all-time highs, a bit like Bitcoin at the moment. If you think of Bitcoin right now, it's broken out above its wake-up line, and it's doing exactly what the gold chart is doing here. But the thing to notice is, hang on, guys, we've still got the Ichimoku cloud there, and we've still got the previous support turn resistance. So, and we've only got 1 star or maybe a second star for getting above the moving averages. So at this point in time, the evidence is weak. There is some evidence there, but it's not conclusive. And this is how you build an evidence case for when to get into any stock, any share. Forget that it's gold. This could be Bitcoin because Bitcoin's doing this now. So we are cautiously optimistic at this point, but history and experience tells us that usually you hit that wall or the resistance, some overhead horizontal resistance, and you're going to go back down again. because what you're doing here is you're building a base from the bear market, a transition that is going to lead you out into a bull market. And it doesn't usually happen in a V shape. A V shape recovery is unusual. It can happen, but it's unusual. So you've got a low probability of a V shape breakout and a higher probability of building a base, getting rejected at resistance, and bouncing around. So let's see what happens next.
No problem. And that's it. It's all about establishing probabilities. Here, we're starting to define a zone. Here, there's a reaction. That's a swing high, clear swing high. So now all this area here, when that price action goes down, it's telling you something. So it's morphing into existence a congestion area. All this here is now, it's starting to become important, right? Because it's not able to close above it. Mm-hmm. Price action goes back down. So here we had the first star. So that's the wake up. The first star is just to tell you that the downwards momentum has halted. It doesn't mean you V-shape. I see a lot of people buying here and they know that a bearish or bullish descending wedge, a target's up there, but we know that we have a lot of statistics that this is rarely the one that brings you back to all-time highs.
Think about market psychology, Tom. Sorry, Pat, to interrupt, but just think about market psychology for a moment. The stock has been going down, or gold as it is in this case, been going down for years. You get a little breakout like that, everyone gets excited. New bull market for gold, everyone piles in. But this is not the time to 9 times out of 10. This is not the time to take a long-term position. You can play the swing move up to the resistance, up to the Ichimoku cloud, up to the horizontal resistance zone, but it's not the move that you're waiting for, and that is nearly always the case. Not always, but nearly always the case. So technical analysis, you're playing probabilities all the time. You're identifying risk and reward. Sorry, Pat.
That's right. And the cloud is still thick. And this should give you clues that there's still a lot of bag holders that need to be eroded before you have a thinner cloud, a higher probability exit. So right now we have 2 stars, barely. The second star, usually we give it when you're above the moving averages, but now it's losing the 1-year moving average again. It's just above the 3-year. So this is nice. It's actually creating a base, flat price movement. Oh, you see it tried to get back above here. It's reacting downwards. So, it gives even more credence to that breakout level, trying to go back up. We're not pulling the trigger. People say, it's a breakout on the daily chart. We're still waiting. Oh, look, here it's starting to get thin. There's an escape route here eventually. So I don't know how low this is going to go, but we're starting to be possibly trying to get an exit. Oh, you see here, it's going down. We're below. So now, you see those 1 and 2 stars, they don't always convert to the 5th star. The 5th star will show you where, once you get the 5th star, guys, you have a much higher probability of reaching your implied measure move. And that's like, I think it's, Tom, you told us it's Rick Rule. He wants to catch the bulk of a move. Well, the strongest bulk of the move is when price closes above important resistance line and all the bag holders are gone, and then you're able to go up.
So we usually have something called an early breakout line on these charts, which is less steeply angled than the wake-up line. So Pat's just drawn a line on there that shows it joins together the swing highs, but it's at a slightly inclined angle, whereas the resistance zone is horizontal. That early breakout line is slightly angled, and that's where you're going to get your next star. It's where you get your next piece of evidence. So we need to break out above the early breakout line, the Ichimoku cloud, and the final breakout line to get the 3rd, 4th, and 5th star. Now, as an investor, you can take a position whenever you want. You could have taken a position on the 1 star or the 2nd star, but really, I wouldn't recommend taking a position on anything less than 4 stars because of the opportunity cost, the time. I mean, this is years. Your first star was in 2015, was it? And you're not going to get your 4th or 5th star until, what was it, 2020, 2021, 2022. So, yeah.
3 years later. So you got the star base it's about giving stars and it gives you, it establishes there's probabilities assigned to those stars. Oh, see, now we're back.
Yeah, I was just going to say this is an example, an illustration of why it's important to not try and catch the bottom. And you're not trying to catch the bottom or catch the top. You're catching the meat of the move, the bit of the move that happens reliably and most quickly. Trying to catch the bottom there, you'd have had 3 attempts to catch the bottom and failed every time, and got caught up in a sideways trend that's going nowhere. And all that time, you could have been invested in something that is breaking out. You could invest in something that is a 5-star breakout elsewhere.
I'm going to play that
Sorry,
out.
No,
it's fine. It's so right now the price is trying to stay.
We're watching here
is.
the price of gold chart play out since about 2017, right?
Yes, in real time. So here we go. And this happens often. So the 1 and 2 stars, the 1 star happens really at the beginning, a lot of opportunity cost trying to get in on the 1 star. Then the 2nd star, you might gain and lose it as you go below the moving average and all that. But once you're able to stay above the moving averages, retest it. The third star, we usually give it once you're above the early breakout line, and it did that. When you close above the cloud, you get another star. And when you close above the final breakout line, you get the 5th star. And usually you see how fast in succession you get these 3 final stars. That increases. It's telling you that there's a lot of bullish technicals or bearish technicals getting destroyed, overridden. And that's telling you something's happening. Market participants are overriding bearish technicals in a fast, successive fashion that now the probabilities of a good, strong move, they're real. You got to believe it. And inflation was peaking in 2019. It was breaking down, and we heard all the stories. But when you look at that chart, I don't want to say go all in, but yeah, it's like if you want to do Michael Saylor type of thing and say sell everything you got to buy stuff, you should have told people to do it back when you have a chart like that, right?
And at that point, if you just zoom out a little bit, Pat, you'll notice that the entire base is sometimes referred to as a Wyckoff accumulation pattern. It's also sometimes referred to through Stan Weinstein's terminology as I always get this wrong, stage 4 base. Is that right, Pat?
It's stage 1 base.
Stage 1 base. I always get stages wrong. My memory is shocking. Stage 1 base. But there are different sort of scientific ways of describing that basing pattern. And I've kind of tended to summarize it by drawing an arc on the chart, because it very visually, one thing that I learned early in my forecasting career is that if you can visualize something very clearly and simplistically, it helps sort of people to sort of visualize and how can I put it? People understand better if you can draw a good picture. Picture paints a thousand words very often. And so using this arc technique, all you're doing is you're acknowledging the fact that entire process has been part of a base building process. And the arc support line is a perfect geometric arc that on a surprising number of occasions acts as like any other support line does. And it acts to contain the price. So from that, this is one technique where you can actually estimate the time to reach your target. So the target clearly is the previous highs, and you can see the target zone there, sort of late 2020, 2021, somewhere around there. It gives you a ballpark timing. Don't expect perfection from these things because you'll be disappointed if you do, but it's just one of many techniques. Sometimes one particular technique will fail, or it's often not a case of the technique failing. What it's a case of, if a support line doesn't hold, it's giving you really important information about that stock or that share. So knowing where these walls of resistance are is very, very important, because you know that the weight of evidence is there to suggest that the price is likely to find support and turn around and go back up again. So if Pat hits the play button, we'll see what happens.
And now this is like before March 2020, March Madness, and beautiful uptrend, and people looking on daily charts, they panic. There's a down day, manipulation. Oh, they're spoofing. I'm getting spoofed in the morning. You know how people show those charts where it's like the price goes up and down, but who cares? If you zoom out, you see, look, did you see March Madness? It came to retouch the arc. That was March, like when the whole market sold off, and look, it just closed where it was. And look, oh, by magic, it went up, and that's it. That's all she wrote. That's
And
that's
then
our
the next thing that you kind of get to be cautious of at this point is because we're stretched from the moving average, and because of the cyclical nature of gold, you would be probably thinking at this point that a handle, this is a cup and handle pattern. Many people recognize my sort of arcs that I draw as cup and handle patterns. And the handle that, if you want to call it that, that's been forming for the last 2.5 years or more, is what we're breaking out of now, or what we're waiting for confirmation on a monthly basis for a breakout. We've already tried to break out a couple of times, but what we're built out is a bullish megaphone on the quarterly chart. So all of these techniques, the star analysis, it's a way of trying to communicate. All it is, it's myself and Pat communicating our technical analysis. So instead of talking about the Ichimoku cloud, the moving averages, instead of talking about sleep mode lines and wake up lines and all of these things that people are, what the hell's all that? Okay, well, is it? If we can just say it's a 4-star or 5-star breakout, I think that does a reasonable job of summarizing what it is we're trying to get across.
So as it shows now, how many stars do we have?
We've reset. So what happens is when you get that breakdown below the sleep mode line that we had in 2021 or wherever it was there, then the star system resets. So we start all over again. We're looking for the same breakout lines, the same slanted breakout lines. We're above the moving averages, and we're above the 12 and 36-month moving average. So you could say that we've got a star for that. We're above the declining, the slanting early breakout line. So there's another star there, and we're above the final breakout line at the moment. So key to all of this is the final breakout line. When you identify the horizontal line of resistance, the final horizontal line of resistance, that is your 5th star. So these star systems, if you want to call it that, they develop on all sorts of time frames. You'll find these star systems on the daily time frame, on the hourly time frame. You pull up the hourly chart or the 15-minute chart, these 5-star breakouts occur on all time frames, and these arc patterns occur on all time frames. So within this monthly chart or the weekly chart, you'll find much smaller fractals of the same thing. Within that 2.5-year handle that we've been building out. You'll find all sorts of arcs and cups and 5-star systems that you can use in your hourly or your daily trading.
Yeah, see, same thing here, back the base. So we when you see these now, you should not dismiss them anymore. If ever you see a 7-year pattern where you were an uptrend, went sideways, and after that the resistance thinning and breaks out, this is the Rick Rule, what he wants to grab, right? He wants to grab this because this is the fastest gains for the longest period of time with the higher probability move, right? Because
if you step back and look at that gold chart, is there anywhere else between 2011 and now where you could have got as quick a move as you did between 2019 and 2020? No. That move that took place there, for the size of the move in the period of time, there isn't anywhere else on that chart where you could have bagged those sorts of gains. And the only way of identifying that is what's most likely to happen is by using the technique that we've just shown there.
Yeah, I think this is part of something that I try to help conceptualize, is to make a plan for investors to be able to understand the market, understand kind of where things are headed, and to be able to capitalize on hopefully a good amount of that.
Yeah, and there doesn't need to be, I know sometimes we sort of go to war on fundamentals and narratives because it can be quite frustrating and annoying sometimes when people they buy in so much to a fundamental story that they fail to look at the wider picture and the wider evidence. But really, in all honesty, all the chart is doing is it's showing you which of those narratives, which of those fundamental stories is correct at any point in time. Because if you stop and think about it, there are so many people, so many views and opinions out there that some of them will be right and some of them will be wrong. The question as a trader investor that you want to answer is, well, who's right and who's wrong? Which, whose idea about Bitcoin is correct, or whose idea about gold is correct, or whatever it happens to be. And the technical chart makes it very, very clear which fundamental thesis at any point in time is the one that is, I've got to phrase this carefully because I don't want to say that fundamental thesis is correct, because it's not. It just so happens that at that point in time, what that thesis is saying is going to happen to price. The price chart is also saying is going to happen to price. It doesn't mean that thesis is correct. It just means that at that point in time, for whatever reason, the price chart is telling you that bullish thesis is the way it's going to work out.
Yeah, it's and that's the trap, because now the price goes alongside your thesis, whatever it is. Then after that, you think it's a thesis is right, and then the price starts breaking down, but my thesis hasn't changed. Whatever, like it hasn't changed my thesis, but the price breaking down. Oh, the market's wrong. The price will fix itself. You hear that sometimes. Jesus hell, like if somebody says the price will fix itself, that means there's a breakdown. You're below one of our objective defined sleep mode lines. You should look at that and say, oh my goodness, okay, well, why should I pray and hope and hold, hoping the market aggregates something by miracle will change and realign the price with my thesis? People have such a hard time. Just step aside. You're not leaving gains on the table. Who cares if you stepped aside, stay to cash or go to another instrument, let the market figure out its 2-3 year consolidation, like gold, right? It went up, and then for 2-3 years it was consolidating. Why hold during that time? Step out and then look for other things that are breaking out, where you could ride Bitcoin up, you could ride oil up while gold was consolidating, because they're printing so much money. Gold has to go to 5,000. No, it doesn't have to go to 5,000, and it might go there, but it doesn't have to go on your timeline, what you think, right? Because I don't know if you were tracking all the precious metals back in 2011, 12, or 13. The thesis, the news were horrible in Europe, right? The banks were collapsing in Greece, were bailouts. Jesus, that was the top for precious metals. So if you were following all those fundamental news, you'd be buying at $1,900 gold in 2011, 12. But a chart trader would see that at 1900 in 2011, it was doing a 10-year run. It was super stretched from the moving averages. It was FOMO. Even SPX was back at nominal highs, starting to break out versus gold, outperforming gold. Like if we go back to that gold to SPX ratio, there was a whole bunch of reasons not to be long gold, or at least stay on the sidelines back in 2011. But if you're just looking at headline news, you'd be piling on, man, in gold at the wrong time.
There's some very good examples as well, Tom. I don't know if you want me to talk about the US dollar at all, but there's a good example there of how to test somebody's thesis.
Well, that's exactly where I wanted to go next, Kev. Yeah. Thinking about, having a couple different probabilities and then seeing, visualizing it with that story, with the chart of how each of those could play out.
Yeah, absolutely. Well, just let's take a look at Brent Johnson's theory for the US dollar, the US dollar milkshake theory. I think probably a lot of people have heard of that, and there's a very good video that explains very well on his Santiago Capital, isn't it? Twitter feed there, put together by Real Vision, I think it was. Anyway, so the DXY or US dollar milkshake theory basically, to cut a long story short, says that the US dollar index is going to go very high to new highs, probably beyond 165. I can show the chart actually. And I thought, well, okay, so we've got this theory out there. It's a narrative, it's a story, sounds great. But is there any actual evidence to support this theory? So, okay, I wasn't really aware of anybody having done any sort of technical breakdown on it. So pulled up the chart and started doing exactly that. So I'll just share my screen and show you what I managed to discover.
And of course, this is important too, because this can affect gold because of the strength of the US dollar.
Yeah, quite. Yeah, the US dollar index does have an impact on the price of gold in the short term. But I've got to take the opportunity here actually to mention the fact that, well, gold is at $2,000 now, isn't it? if you follow this this DXY chart, we're at about 101 at the moment on DXY. If we go all the way back to let's say, well, there are several. Put it this way: there are several points in history where DXY, in fact, even down here in 2008, and more recently, DXY was around about 70 or so. During the period that DXY has moved from 70 to where it is now, so it's gone up by 30 there, so it's gone up by about nearly 50%. Gold has gone up; it's not gone down. So during this period here, over the last few years, today's value of gold is several $100s higher than it was back here.
Mm-hmm.
So over time, DXY, yeah, it's risen, but so has gold. So you have to get out of your mind this kind of idea that gold has to go down when the US dollar index goes up. That's not true. What is true that in the short term, if the US dollar index is going up, it can put some pressure on gold over the short time frame. But over a long period of time, actually, you can see that over this long time frame, all that's generally happened with the US dollar index is it's gone sideways. I mean, we're permanently trapped, it seems, between about 70 and 120. You know, okay, occasionally goes a bit higher, occasionally goes a bit lower, but the US dollar index is kind of in a range between about 70 and 120.
To exaggerate your point, Kevin, let's look at gold when it was like $40 in the late 1960s, or when it was pegged, whatever, 1973. It was practically the same DXY level as today there. So even with $50 gold, by the people's rationale that the US dollar changes the gold price, so that means, guys, you should wake up. Okay, if it's not the US dollar primarily moving gold price, what is? And it's purchasing power. That's what it tracks. And purchasing power is that chart divided by the producer price index, proxy for inflation. That's what gold tracks more than. So if the US dollar goes bonkers, but there's so much more inflation to offset the US dollar outperformance of the yen, of the euro, and all that, gold will go up. And that's when you see gold and US dollar go up, and people don't understand, well, it's because there's so much inflation that it's destroying your purchasing power.
So the theory being that the US dollar index is going to go much higher, somewhere, as I say, beyond 165, effectively off the top right hand corner of this chart.
Wow.
So from a technical chart point of view, the way I've been looking at the US dollar index is this major resistance line and the major support line as being the major controlling support and resistance lines. You can see three bearish rising wedges on the chart, and I've labeled them 1, 2, 3. And each time it breaks down from one of these bearish rising wedges, we go into a full-on bear market for the US dollar, and it loses ground against the euro, the yen, and the British pound. So therefore, the US dollar index, which is what this chart is, falls, telling us that the US dollar is much weaker than its peers. So if and when we get to point A, we're going to get a severe test. But using the major resistance line and major support line, my explanation for this this period in time where the chart broke out above it is to say that this was an unrepresentative blow off top that was powered very strongly by the events of the early 1970s and the mid 1970s that led to a huge surge for the US dollar index as the US dollar was no longer pegged to gold following the dissolution of, or breaking up of the Bretton Woods Agreement. So I think that the steepness of bearish rising wedge number 1 was an incredible beach ball held under the water type scenario. But following that, major resistance line number 2 is what's been in charge. And that being the case, we've recently hit it and are heading down, and could very well come down to point B or even point C to retest the major support line. So that's one roadmap. But for the milkshake theory to hold water, or to hold milk, we have this milkshake line, as I've called it. And if you take the high point from 165 on the US dollar index and you join it to the next high point here in whatever year that was. Sorry, I've got my part of my screen covered here, around about 2001, wasn't it? And then down to the point where it broke out in 2015, I think it was here. What we've got, if you use that milkshake line, is a bullish descending wedge. You've got a major support line and you've got the milkshake line creating a bullish descending wedge, and we've broken out above it, back tested it, and have moved up, and we've tested the resistance line that I previously mentioned. So the net result of all of this is, my take on it and my conclusion from it is, for Brett Johnson's milkshake theory to work out, we either need to come down to 95 on the US dollar index at point A and then move strongly to the upside and break out, or conceivably we could come all the way down to point B at 76 or thereabouts in the US dollar index. And that would not mean that Brent Johnson's theory is dead in the water. What it would mean is that at point B, we've come all the way back down to back test the milkshake line in a huge bullish descending wedge that could then very well lead to a huge move to the upside for the US dollar index. It's only if DXY falls below 76 or that region around 76, depending on the timing when we hit that line. If we fall below that, then the US dollar milkshake theory, to my mind anyway, is not going to work out. We're just going to come all the way down to point C and test major support. But it's an interesting dichotomy of technical chart analysis here. You've got two very clear pathways, one which leads to a very large upside move in the US dollar index imminently, and another that that takes us all the way down to somewhere near 76 on the US dollar index. I mean, that would be very bullish for gold in the interim. And interestingly, it takes us to the late 2020s, which a lot of the charts are pointing to as a potential sort of high point for precious metals. The only other thing to mention on this chart is the cyclical sort of 15 or roughly 15-year cycle for the US dollar index. If that were to continue to occur, and the sort of roughly 15-year cycle holds true, then the next low point is indeed at point A before the next major turn to the upside. So if you believe in the sort of 15-year cycle, the US dollar index, then it's quite likely that we only come down to 95 before moving much higher. Alternatively, the cycle could lengthen. Goodness knows what reasons there might be for that. But as I say, regardless, that would mean gold peaking sometime in the late 2020s, between 2027 and 2029. But also bear in mind as well that once the US dollar index hits its low point, and I should mention this actually, I nearly forgot, gold actually doesn't peak until 2 or 3 years after that. You see how the US dollar index reached its low point in 2008. Well, gold didn't peak till 3 years later. Same in 1992, gold didn't peak till about 3 years later. 1978, the US dollar index hit its low point. Gold peaked a couple of years after that. So wherever the low point ends up being for the US dollar index, that is not going to be, or is unlikely to be, the top for gold. You have probably another 2 to 3 years after that where the US dollar index and gold go up together.
Kev, could you give us a quick rundown on the mechanics of what creates that much demand for the US dollar to move it so much higher in Brent's scenario?
I was hoping you wouldn't ask me that question. I've watched the video 2 or 3 times, and it's to do with dollar demand. So much of the US dollar is held overseas. So a lot of currency is held overseas. It's the world's global reserve currency, as we all know. And even today, despite de-dollarization and all that kind of narrative, it is still the premier sort of reserve currency globally. Might not last much longer, but that is still the case. And because of the dynamics that Brent describes in his theory and is shown on the podcast, there, a lot of those dollars held overseas are drawn back to the United States. There's a huge sort of demand, if you like, a huge pull for those US dollars back into the US. I seriously, I wouldn't even want to begin to.
That's fair.
I wouldn't do it justice if I tried to explain his theory. I look at things very much from a technical charting perspective, and the narrative side of it. I watched the video. I wouldn't want to try and explain it because I wouldn't do it justice, and I'd probably have Brent sort of on sending me DMs saying, Kevin, you didn't explain that properly. So what I would recommend is that people go to Santiago Capital and watch the explainer video. But it's to do with the way that US dollar or dollar demand surges to and from the United States, and the dynamics around that surge in demand from between dollars held overseas and dollars held within the United States.
Mm-hmm. And Tom, that's the beauty of the chart, because Brent has his theory, then this other guy probably has the opposite theory, and then just all these guys across the planet all have different theories, each pushing different amounts of money. But eventually, a good question to ask Brent would be, well, at what point does your thesis, okay, my milkshake's not going to happen? And Kevin, that's what he technically, from a probability aspect, he put the lines in the sand. Because I see that chart, Kevin. I had a question, like, let's say it bounces on A. It doesn't mean it goes to milkshake. There's a wall at 101. It could just do like a head and shoulders. It could stop at 101 and then crash down again, right?
It could do. The 16-year cycle is one piece of evidence that is sort of in favor of point A being a major low. But if you disregard that particular aspect of it, then there's no particular reason why we can't just go up to, as Pat says, 101, 102, or even up to this area of shaded green before then eventually breaking down. I mean, to me, the fact that this is the third major bearish rising wedge carries quite a lot of weight, because these bearish rising wedges that build out over such a period of time, well, they're called bearish rising wedges for a reason. So, the probability is that this will break down and will lead to significantly lower lows, whether it's at point A or whether it takes longer and we don't break down, I should say, for several more years. But for the milkshake theory to really take hold, we have to get above this area that I've shaded in green. Mm-hmm. We need to really bust above the major resistance line, and that's what would technically unleash Brent's scenario. At that point, when we get above about 115, then Brent would be able to, or any technical analyst would be able to confirm that it's highly likely that the US dollar index is going much higher. We don't know how high, but a breakout from this large pattern, the major support and major resistance line, a breakout above that would signify the likelihood of a very substantial move to the upside. So that we've got lines in the sand. It's a roadmap. And it's, having that map helps you to know when to turn bullish, when to turn bearish. It helps you to know when your theory, your idea, is either being confirmed or it's being, you're having evidence that it's not correct.
Mm-hmm. Excellent. Well, guys, maybe if we could, let's run through a couple charts, just to kind of update the audience on where we are. Maybe we could start with, let's say, a gold and silver miners ETF, just to try to give our listeners some perspective on how you see, breakouts in a couple of these different asset classes as well.
Well, the ASA chart, right? Could just go back to the ASA chart, or GDX, or any of these.
The reason we use ASA, by the way, for anyone who's not sure, is because the price history goes back way further than the HUI or the GDX. So if you're looking for a precious metals fund chart that has a lot of history, then ASA there goes back to the 1960s.
So this is what I call a paradigm shift breakout line. We had a 5-star breakout here. It ran up, it did a reverse symmetry move to the wall, and then it went sideways, it went down. But this essentially, when you have a move that goes up and starts going down, your attention should be, okay, there's a line somewhere morphing into existence, right? Some important level. So this one's important. I have a lot of volume right here. I have a huge volume defined node right here. So I know that if ever the price, where's my squiggly line?
And again, for people watching who, volume defined nodes, that graph on the right-hand side there with the peaks and troughs in it, the peaks show you where there are peaks in trading activity, buying and selling. And that quantity of buying and selling at that level establishes a support and a resistance level. And when you look across on the chart from that volume node, that peak in the volume, you can see all that price action. There's tons of price action at that level where that volume node is. So the volume graphic on the right-hand side, all it's doing is helping you to visualize exactly where that sort of support and resistance is. But you can see it visually anyway on the price chart itself. You can see where price lingers for a long period of time, creating that volume.
Exactly. And look, it's moving out. This chart looks exactly like the gold to SPX ratio, did a base, pull flag. It's starting to move up. There's a whole bunch. There's a lot of resistance here. This wall, previous support, once you break down, becomes resistance. Could even stop here. We're not quite sure. Could retest here. But as long as it's been doing higher lows, higher lows, higher lows, higher lows. It's been doing higher lows since 2015. As long as it's able to rush up, and then whenever it pulls back, it still does a higher low, you're in a bullish configuration. But again, this is still tricky. The really, really strong move will be a reverse. It will be once it breaks above this final defined volume node. Maybe there's even one more here. Of course, there's always resistance along the way.
And can you see the confluence of evidence that's about to come into play here? Because you've got the Ichimoku cloud, you've got the 3-year moving average, you've got that wall of resistance that Pat was talking about, you've got the paradigm shift breakout line. So all of those obstacles will tumble in a fairly short period of time. You know, in the grand scheme of things, it might take a year to go through the cloud, the moving average, the horizontal breakout level, the paradigm shift line. It might take a year to do that. It might take 18 months. But in the grand scheme of things, from this chart, that's relatively quickly that you're ticking off all of those final obstacles that are in the way. And it's not until that final obstacle is beaten, we get that final obstacle out of the way, then you can really start to have confidence. And technical chart analysis is all about giving you the confidence, because you're weighing probabilities, you're weighing the most likely outcome. And when you're taking a trade, you want to have some tangible evidence, that some reason why you're feeling confident. You don't want to take a trade. I mean, why would you take a trade if you're not feeling confident? So that your confidence level, if you want it to, can come from evidence rather than a narrative or a fundamental story. You can get your confidence level from, well, what Pat's doing here is, for want of a better phrase, it's scientific evidence. It's analyzing all of the investor psychology, because that's what the price chart is. The price chart is pricing in not just what I know and not just what Pat knows and what you know, Tom. Is pricing in what every investor, with all of the knowledge and information in the market, including the big players, is pricing that in, and it's reacting to their actions. It's not reacting to their thoughts or their fundamental stories. The price chart only reacts to your actions, or should I say, reacts to the reactions of the market. So what you're analyzing here is the truth. You're not analyzing a story.
You're analyzing what's actually happening.
You're analyzing what's actually happening. And as it happens, and as it turns out, if you analyze what's actually happening, you can get to the truth of the matter much more effectively than if you analyze what ought to happen, or what people, or what a particular person thinks ought to happen or should happen or might happen, or this company's got a good management, or that. Look, a mining company with good management is not going to do well in a bear market. That's why that's why all of the miners in the HUI index sucked over the last several years. It made no difference if they had good management. They all went down by God knows how many percent. You need to be in a bull market, so you have to have the capital flows. That having good fundamentals isn't going to help you.
This, Tom, is the gold and silver metal trust. So this is gold and silver. If you would combine them in one chart, this is what you get. It's called the SEF. So that's also pretty bullish there. So when you combine the strength of gold and silver, which is not at all-time highs, you put them in one chart, you get this uber bullish chart where you have a 10-year trend line, paradigm shift breakout line, which is starting to go back above it. You have a wall here, previous support term resistance. If ever you close above this line here, I might have to put this on the quarterly to remove some noise, remove indicators.
That's interesting, Pat. I noticed that the the price there broke above the Ichimoku, or bounced off the Ichimoku cloud on the monthly and the quarterly chart there.
Yes. This is looking very, very, very bullish for both precious metals right now. If it's able to close June above this line here, it's also wall. That's bonkers. I mean, gold, it's holding its ground at the least. Gold silver ratio probably going down. Silver is probably going to be going up. And we know that if silver goes up, the miners also go up, because silver and the miners, they track gold's performance versus SPX. You know what we should do, Kevin, to make sure Tom's listening? We should do our like chart trading extravaganza, and we should quiz him at the end and make sure he was listening.
Yeah, how you been listening, Tom? We're going to give you a test at the end. What's that test?
But you see the bullishness, right? I don't know, like if you're like you're just a chart like novice. I know you've interviewed us a lot, but you must see the bullishness in this chart, right? Is it speaking to you, or does this look bearish? Does this look like $1,400 gold, or is this what do you see here? It's like,
well, for me, Pat, I'm always trying to let's say disconfirm my thesis, right?
Okay.
I'm always adding to my weight of evidence for how I see things, and you know, trying to be a responsible host as well. I try to be neutral to let each person explain their thesis the way that they see it. But, you know, at this point, from a macro perspective, from a technical perspective, from all of these different perspectives, it doesn't seem like we're in a place where we can reasonably expect that gold could be, you know, $1,000 for the next 10 years going sideways again.
Goodness.
So Pat's just put some percentages on there, and I just want to, can I just make a point here? So that's probably about right, 80%, 20% in my view anyway, something along those lines, 75, 25, however you want to put it. But right, so technical analysis gives you a way of gauging the probabilities, because you are able to objectively, rather than subjectively, objectively analyze elements of the price chart. Okay, so, but I just want people to realize that if you say something's 80% likely to happen, or 80% likely to go up and 20% likely to go down, if it goes down, that does not mean you are wrong. So if I say Pat puts that chart on Twitter now and say it goes down, you're going to get a load of wise guys on there saying, it went down, you're wrong. Mm-hmm. No, he wasn't. I tell you why he wasn't, because if you're analyzing the probabilities correctly, and if he's analyzed that chart correctly, then 2 times out of 10, it should go down. Mm-hmm. So if Pat were to put 10 charts up like that, one for gold, one for silver, I don't know, and 8 other charts for platinum, copper, and, you get the idea. So he puts 10 charts on and he analyzes them like that. 2 of them should be going down if he's done it correctly. Mm-hmm. Yes. Do you see what I'm saying? If something has a low probability of happening, it should happen.
That means it still can happen.
It means it still can happen, and it means more than that. It means that in this case, 2 times out of 10, it should happen. Mm-hmm. Because if it doesn't happen 2 times out of 10, you've got your probabilities wrong. If it only happens one time out of 10, Pat should have said it was 90-10.
That's right. That's right.
So that's really, really important for people to understand and just be aware of that fact. Be aware that very low probability events do happen. If it was 99% likely to go up and 1% likely to go down, think how often things that only have a 1% chance of happening do actually happen. Mm-hmm. How likely is it that, I don't want to be morbid, but how likely is it that a plane is going to crash? It's incredibly unlikely. Mm-hmm. And yet, guess what? The planes do crash. So, that terminology and use of percentages and probabilities, very, very difficult. A lot of people struggle with that, but I just wanted to kind of make that clear.
One other one, I think if we could go just over one more chart, is the uranium chart. You guys have, Kevin, I think you've done a nice arc on that. And I I do owe my uranium part of my audience some analysis there and an update. So if we could go over that quick.
I'll show you the uranium chart. I'll just share my screen. So uranium, as probably everybody knows, has been in a pretty severe pullback, hasn't it, for quite a while now. Just bear with me. I'm just trying to share my
while Kevin's setting that up, I did a future uranium, guys. They track also the capital flows as defined by the gold to SPX ratio chart, right? It's no different. So all these commodities. So even while Kevin's going to show you some bearish looking charts where there's uranium has been consolidating and drooping sideways and down for a while, when gold breaks out this SPX, eventually there's probabilities that it will help it get afloat.
Yeah, this is the URA chart. So this is the uranium ETF. It's kind of brings together a good number of the uranium miners and represents those in the ETF here. So again, using the sort of 5-star technique, if you will, I'll just put on the Ichimoku Cloud as well. I'll show you that. So if you imagine or if you visualize the declining resistance line here, perhaps you can. There are probably several that you could put on this chart, but there's one there, for example. So the first star would have been awarded to this particular ETF in the uranium sector sometime back in perhaps, I don't know, 2017, 2018, that kind of time. And then it became very clear what was going on with this breakout. I think it was around about 2020 when we got a false break to the downside. This support line got broken to the downside, and we had this triangle type of pattern. I could just bring this line in a little bit tighter here. And when you get a breakdown from what should be a bullish descending wedge, and this was the COVID lows in March of 2020, very, very likely at that point, statistically, that this is a false breakdown and you're going to get what's called an around the apex move to the upside. The apex of the triangle is just where those two black lines meet. That's the apex there. So when you get a false breakdown, an around the apex move just means a move that pushes up through or around the apex. And even better than that, it broke out and back tested to perfection, absolute perfection, the point on that apex there. Mm-hmm. And that was incredibly clear from a technical chart perspective that something quite special was developing here. The sort of final confirmation of that particular move came, I suppose, when we broke above this higher level here. We got above the horizontal sort of final breakout line, which is somewhere around about $18.50, $19, that kind of area. And then we hit resistance. There's a zone of resistance, sort of wall of resistance from previous price action, and we've kind of hit that zone and pull back. But we've got an arc which helps us with our visualization, and we've also got the Ichimoku Cloud. If I zoom in a little bit more, you can see, and I'll probably put the moving averages on here as well, and put the 12 and 36 month moving average on, and you can see that we've got the Ichimoku Cloud, this green cloud starting to rise. The 3-year moving average is rising, and we've got two arcs in place, one from the candle body and one from the wick of the candle in March of 2020. So there's quite a complicated technical analysis on this chart that tells us that in a severe market event, such as some kind of liquidity-driven event, banking crisis, whatever, something terrible, then the outer arc is the one that would be very likely to give final support. Mm-hmm. But as long as we don't get that kind of terrible, disastrous, market event, then the inner arc is the one that is guiding the price up. So I've got this green quadrant, which is where the URA ETF is likely to sort of bounce around in for a period of time. But we've got a wake-up line here, very clear, clearly defined wake-up line, and a horizontal resistance line is around about $24. And for me, I think once the URA ETF gets out above that $24 level, that horizontal lower part of the resistance zone, it will already be above the wake-up line at that point. So we'll be above the wake-up line, above the Ichimoku Cloud, and above that horizontal $24 level. Then at that point, I think the probabilities will be very strong of a move that takes us quite probably up towards the sort of $50 level. fairly strong sort of reverse symmetry move back in that direction. But in the meantime, the 3-year moving average could give us the support that we're looking for. But it's quite possible, quite probable that we do come back down a little bit lower and test that arc there. So a number of technical analysis techniques there, but there are many others that we look at in the background. It could be the stock RSI, the rate of change analysis, the URA versus SPX chart. All of these elements are brought together to build an overall view and build an overall analysis of the probabilities, and that's where we get our sort of our confidence levels from. We usually talk about it in sort of language terms, talking about how confident we are, but sometimes we'll put percentages on the chart to try and convey, in more precise terms, just how confident we are. But it's those confidence levels that are really important in technical trading or any kind of investment. Really, you need to know, whereabouts am I? I need a map. I need to know where I am. If I'm whatever I'm doing in life, I need to have a plan. I need to know, if I'm going off track. And without a technical analysis chart, you're just never going to know what the heck is going on. If you didn't have this chart here, you'd probably be scratching your head thinking, why is uranium going down? Why? The fundamental story for uranium is just as good now as it was 2 or 3 years ago. Why is it going down? Well, it's going down because the technical chart said it was hitting a resistance zone, and it's just doing what tends to happen in bull markets. You hit a point, a particular point, a clearly identifiable point, and then investor sentiment cools off, and then that refuels for the next sort of stage of the bull market. And as long as this chart pattern continues to play out, then we're in a very good, very healthy bull market for uranium.
Excellent. Well, I think that's a good place to kind of wrap things up for today, guys. I really appreciate you being so liberal with your charts and your advice and the deep dive we took here on technical analysis. Is there anything else that you guys want to touch on before we do wrap up?
We didn't cover cryptocurrencies. I'll just briefly mention those because some people might be interested in cryptocurrencies, and Bitcoin's looking particularly strong at the moment. There's a very clearly identifiable resistance zone, just like the ones we've been talking about on gold and on uranium there. And that resistance zone stretches from around about 31,000 up to about 35,000. If ever we get a confirmed weekly close on the weekly chart above that 35,000 level, then that really starts to shift things quite a bit for the for Bitcoin in terms of evidence, and we could see a continued strong run from there. But the probabilities and the evidence do suggest, on balance, that we're hitting that, just like gold did. As we showed at the start of the interview there with gold, hitting that horizontal resistance level, and it's a very dangerous time to be sort of entering cryptocurrencies at that point. So the probabilities do suggest a significant pullback is going to occur after it hits that zone. And the stock markets have a lot to do with cryptocurrencies as well, of course. The movement of stock markets, and particularly tech stocks, are very sort of intimately tied to the fortunes of cryptocurrencies as well. So we're still somewhat cautious on those, I would say. But and anybody that likes what we've been saying, you can find us on the website, of course, northstarbadcharts.com, and my Twitter handle at northstarcharts. Of course, at Bad Charts 1.
That's right. Somebody else has bad charts. I offered him $10 billion. He said no. Okay, fine. I just added a one.
You should have upped the offer there, Pat. You're being a cheapskate.
Yeah,
I know, but I'm running out of money there. It's tough.
Never. Don't believe it.
Well, at one stage, we're all going to be millionaires and billionaires, right? Because they're just adding zeros.
Yeah, well, that's great, but then a pint of beer is probably going to cost me $1 million by that stage. So it's all relative, as they say.
Yeah.
Thanks, Tom, there for having us on. Your channel's great. I listen to it all the time, and hopefully you stick around there till the end of the bull market there.
I appreciate that, Pat. And as of right now, I have no plans on going anywhere, and I always appreciate getting to speak with you guys. As you know, we've talked many times through the years here, and continue to value your guys' work and look to it for great references and perspective.
Great. We'll
Awesome.
keep drawing those roadmaps for you.
Perfect.
Yeah.
All right.
right.
Thanks,
Bye,
guys.
guys.
Appreciate your time today.
Cheers, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.